The stock market is crashing yet again. But this time, it might have all started with just one man and tariff announcement that rattled the world. You've seen the headlines, markets tumbling and then rebounding, up and down. Analysts shouting all about bear market territory and news tickers flashing in red. I've worked with wealthy families over 2 decades and have over 50,000 hours of experience, and I can tell you what's happening now is terrifying most investors. But behind this latest drop isn't some mysterious force, it's a move that has caught investors largely off guard. Donald Trump launching a fresh volley of tariffs, this time broader, bolder, and with timing that has spooked global markets. So is this the start of a proper global meltdown, or just another overreaction that will fade like all the other ones that have gone before? Today, we're breaking down exactly what triggered the fall and what it really means for your investments and how to make smart decisions whilst everyone around you is losing their heads. Let's start with what actually happened. The most recent sharp drop and then bounce back in global markets wasn't just random. It was all kicked off by President Trump's announcement of sweeping new tariffs aimed not just at China, but by a host of other major US trading partners. Now, markets hate uncertainty, and this move didn't just raise eyebrows, it triggered a full-blown spike in volatility. The reaction was immediate. The FTSE, the S&P 500, and all global indexes were sharply down, with trillions being wiped off. Investors started dumping riskier assets and scrambling for safety. But before we jump into panic mode, let's take a deeper look. Markets aren't falling because businesses are suddenly bad. Let's be clear, this isn't about the actual fundamentals falling apart. The companies haven't stopped making profits overnight. Your investment in Microsoft or Unilever or other great companies of the world haven't suddenly become worthless. This is simply about perception. Markets move based upon how investors feel about what might happen next. And right now, that fear is that a full-blown trade war could choke global growth, slam earnings, and maybe trigger a global recession. But those are maybes. They're scenarios, not certainties. Volatility like this, it's actually quite normal. Whilst a lot of investors are treating this like it's unusual, it's actually not. Market drops, even big ones, are actually completely standard. Here's something to consider. Every single year, the market has had temporary drops. Most years, it falls 10 to 15% at some point, but still normally ends the year up. These drawdowns or volatility are just part of the deal. They're the price you pay to benefit from higher expected returns. What we're seeing now, whilst it's dramatic on a day-to-day level, is entirely within historical norms. Currency moves, however, are slightly adding to the pain. For example, if you're investing from the UK, you've likely noticed something else. This debt feels worse than expected, and that's partly down to currency moves. Back in 2022, markets dropped around 26%, but because the pound was falling against the dollar, UK investors didn't actually feel the full hit. This time it's different. Sterling has climbed roughly 8% since January, so dollar-based holdings now look much worse on paper. The market's down, and with the currency effect working against you, you get a double whammy, and it's tempting to just wait all of this out, but that's a trap. Let's say, for example, you have $2 million invested and you see it drop to 1.85 million and think, right, let's pause until things calm down, let's move it all into cash. Here's the problem. By the time things feel safe again, markets have normally rebounded like they did yesterday at a record level. Miss the 10 best days in any given year and your returns could be cut in half. The biggest up days almost always follow the worst down days, and they don't send a calendar invite before turning up, they just show up. So trying to sit on the sidelines and feel safe in cash often does far more harm than good. Think of it like flying a plane through turbulence. You wouldn't get off mid-air just because it got bumpy, would you? Market drops are actually quite similar. The turbulence feels very unpleasant, sure, but the plane is still flying towards its eventual destination. Jumping out mid-flight is rarely going to be a smart option. The media makes all of this worse. Let's be honest, headlines are designed to freak us all out. No one clicks on markets are down slightly, totally normal headlines. Instead, you get global markets plunge and investors panic amid crash fears. And this is because fear and greed sell. But it also fuels anxiety. This is where having a proper lifetime investment strategy makes all of the difference. A good life strategy or cash flow financial plan already assumes that events such as this are inevitably going to happen. When we build serious portfolios, they're not based upon wishful thinking. They're built to weather exactly this type of storm. They include cash buffers and defensive assets such as short-dated bonds and global diversification in equities to ride out storm. The war chests and asset allocation strategies are carefully designed and tested for times just like these. This isn't the time to change strategy. It's the time to trust your strategy has already accounted for this. Let's now look at the real challenge, which is our emotions. Watching a portfolio drop, even though you know it's temporary, is tough. That sinking feeling in our gut, that annoyance, that frustration, it's totally normal. But making decisions based upon this fear and annoyance is where the damage really happens. History being our guide shows us those who stay invested during downtimes recover. Those who panic and pull out often miss the recovery. Let's run a quick thought experiment. You pull your money out of the markets today and sit in cash. Markets then rebound in 3 months' time. You then have to make a decision to do you get back in there then, or do you wait longer just in case? By the time you feel confident again, you've already missed out on the best part of the market recovery. This is where real investors earn their long-term higher expected returns. These long-term returns come from staying the course during times exactly like this, not from clever market timing trading, not from trying to call the bottom or predict what's going to happen next, but from holding your nerve when it feels really uncomfortable to do so. It's why the most successful investors aren't necessarily the smartest, they're just the most disciplined. Perspective is absolutely everything to this. Zoom out 1 year, 3 years, 5 years, and this dip looks just like a little blip, but zoom in 1 week and it looks like the world is ending. Where you put your focus really matters, and investing wisely is about playing the long game and not trying to micromanage every bump along the way, which can create stress, anxiety, and missed opportunities. But of course, it's easy to say, stay calm when it's not your money. What if you're the one watching your family's portfolio drop 6 figures in a single week? What if it's money that's supposed to support your retirement, your kids, and your future? Well, that fear, that's very real. And it makes you want to do anything, but reacting emotionally is often what hurts us really badly in the long term. Let's take an example. A client had $1.2 million invested across global equities. In a sharp market dip, it fell to just over $1 million. Understandably worried, they asked us if it was time to de-risk and move it all into safer assets. But after walking through the data, the recovery patterns, the built-in protections, and how their life looks in the future, they decided to stay put. 6 months later, the portfolio was back up, and by the year end, it had actually grown past its original peak. Now, there's no magic to this. There's no timing, just time in. Time, patience, and discipline. So, here's the truth. This market drop, it may not be the worst we've ever seen. It definitely won't be the last. And it's not really a big surprise. It's not even unusual. It's just a normal part of investing. The people who come out ahead aren't the ones who read the most headlines or make the most clever trades. They're the ones who stay calm, stick to their plan, and trust the scientific, evidence-based process. Because investing behavior beats brilliance every single time. So, what do we make of this latest crash? Yes, Trump's tariff announcement sent shockwaves throughout the entire global market. Yes, stocks have taken a very big hit. And yes, it feels deeply unsettling to watch your portfolio drop. But history tells us these moments don't last forever. Markets always recover. New highs always come, and those who stay invested, who stay smart, and stay the course are the ones who benefit the most. You don't need to be clever, you just need to be the most steady. Have you ever wondered how the wealthiest invest their money? Check out my video here and find out.